and how leasing emerged as a mode of asset-backed funding. The use of leasing for the purpose of funding, which is introducing the concept of financial leases. Today, throughout the episode, will be concerned back on the distinction between financial leases and operating leases. Um, so the distinction between financial leases and operating leases has been crucial to the very development of the leasing industry. The distinction emerged from accounting standards. Accounting standards on leases are not new. They have been there for, I would imagine, over 65 years now. And this is where the accounting standards for the purpose of bringing a specific method of accounting for leases which have the overarching characteristics of a financial transaction, where leasing is just a modality. The inherent substance of the transaction is financing. That's where the accounting standards thought of bringing a different method of accounting, because accounting is done based on substance, not based on form. And therefore, the standard setters realize that there are leases which are almost like financial transactions. They are leasing, they have the facade or the look of a lease transaction, but intrinsically they are financial transactions. Therefore, they should be accounted for as financial transactions, which means similar to a plain vanilla loan transaction. And with this mindset, with this intent, the standards distinguish between financial leases and operating. Way back, would probably go back to 1960s, 1940s, probably distinctions that the discussion started. I would imagine the first accounting standard, FAS 13, would have probably been 1960 something, and then the IS 17 would probably be 1970 sometime. So it's been around for decades. Over time, the distinction emerged for decades now, and this distinction has been crucial to the very development of the leasing industry, though the standards themselves over time have undergone a significant change. That's something that we will discuss as we go forward later. So in terms of what's an operating lease, if you recall what we mentioned last time, that accounting standards would distinguish a lease which is actually a financial lease. An operating lease doesn't need to be defined. A lease which is financial lease is defined. A lease which is not a financial lease becomes an operating. So any lease which is not a financial lease is an operating lease, but therefore it's crucial to understand what is a financial lease. And every lease minus a financial lease will be an operating lease. But essentially, an operating lease basically implies retention of an asset-based or asset-backed risk by the lessor. In a financial lease, the risk and rewards are largely or substantially financial. Lessor retains financial risk and financial rewards. As we move from financial risks to asset-backed or asset-based risks, or asset-based rewards, risks or rewards are emanating from the asset. The lessor takes asset-based risk or asset-based rewards. The lease becomes an operating lease. And this retention of, by the way, we're talking about risk retention here. Risk also implies rewards. Risk and rewards mostly go together. Risk is what? Risk is absence of a reward is also risk. And not facing the risk is a reward. Retention of risk and retention of rewards therefore go hand in hand. If I am able to prove one, the other one automatically gets established. So risk retention or reward retention may be in many forms. For example, the most common form, for example, could be residual value risk. And from episode 1, we noticed that in case of financial leases, the lessor takes a minimal residual value risk, which also he might want to get a guarantee from the lessee on. Therefore, that risk also is quite often lessee guaranteed, and hence that risk is also eliminated. But in an operating lease, the lessor takes a significant risk on residual value. It may also be by way of making the lease fully or partly cancelable. That would mean cancelability option, the lease being cancelable. A lease may be either cancelable at any point of time. A lease may be cancelable at any point of time, but the lease may be cancelable after a certain time. You would recollect from episode 1 that financial leases are typically non-cancelable. A financial lease is typically non-cancelable. So I can think of a non-cancelable lease. I can think of a fully cancelable, that is anytime cancelable lease, or I can think of a lease which is cancelable after a certain period. So even either way, if it introduce cancelability risk, that would mean the lessor gets exposed to risk of residual value, which is quite obvious. If the lessee chooses to cancel the lease, that would mean the lessee would return the asset. And the moment the asset comes back, there'll be no further rentals to come. That would mean the lessor is now exposed to the value of the asset. So cancelability risk or the risk of residual value are actually two aspects of the same risk. The lessor may also take risk on maintenance or may take some other risk on the asset. So there might be variety of risk the lessor may take on the asset, which would all go on to make the lease a non-financial lease, because in a straightforward financial transactions, we don't expect a financier to be exposed to risk of asset values except by way of security risk. Like I mentioned last time as well, that in case of a loan transaction as well, should the loan face a contractual breach, the lender will also be exposed to risk of residual value, but that's a credit risk and not asset-based risk. Now, in case of operating leases, typically a lessor would have some kind of assistance with the vendor because the lessor is obviously taking risk on the asset values, and therefore some backup, some understanding with the vendor would probably assist the lessor in mitigating that risk. Uh, an operating lease is close to what is called a true lease. Now, this is something which is a legal issue, and we will discuss as we discuss legal aspects of leasing later. An important point which we need to first quickly say before we go further is that in the Indian leasing market, which is at striking contrast with global markets. In global markets, financial leases still predominate. Largest volume of leasing world over would still be financial leasing. Operating lease will be probably a small fraction. But in India, by way of a contrast, financial leases have largely disappeared. Most of the lease transactions are operating leases. And the reason for that could be that in financial lease, given the fact that the lessee does not claim any benefit typically associated with lease transactions, the very motivation to go for lease instead of a loan dies down. Neither does the lessor see a major benefit, nor does the lessee see a major benefit. On the contrary, the lessor might see a downside. And this is something which, once again, we'll probably discuss as we discuss further in the later episodes. But um, initially, when leasing started in India, it was obviously entirely 100% financial lease. Later on, financial leases with the introduction of VAT, value-added tax, and subsequently GST, financial leases became sort of less preferred, and therefore people would try to see an advantage in an operating lease which would be significantly different from a loan transaction. Hence, operating leases are predominantly done in India. Financial leases are still done by some entities. I'm not saying financial. However, comparatively, the volume of operating leases is much higher than financial lease. So the risks that the lessor may retain in an operating lease might be residual value risk, might be maintenance risk, might be occupancy risk, might be operational expenses, or lessor may service the asset. That might take the transaction back to what, if you recall what we discussed last time, a service transaction. It might make it similar to a servicing transaction. Lessor may take the risk of insuring the asset. Lessor may also have rentals which are based on pay-per-use, use-based or performance-based rentals. That once again takes it closer to concept of a service. That brings us to the understanding of a financial lease. What's a financial lease? Like I mentioned earlier, I'm reiterating. What we need to understand is the lease financial? We need to understand, is it a financial lease? If not, the lease is an operating lease. And in episode 1, I faced a question, how do we know whether the lease is financial lease or not? Looking at the lease contract, looking at the term sheet, looking at the language of the lease documentation, do we make it out whether it's a financial lease or operating lease? My answer would mostly be no. The terminology, the documentation, the face of the lease agreement by and large still looks the same. So optically, there's no difference. The difference lies in terms of the structure of the contract, basically the exposure of the lessor to the residual value. That would mean if the lessor is recovering almost everything by way of non-cancelable unconditional lease rentals, then the lease happens to be a financial lease, or else the lease would be an operating lease. So that brings us to understanding of what's a financial lease. Financial lease, I mentioned earlier, and therefore I reiterate, the distinction comes from accounting standards, and therefore the definition also goes back to accounting standards. Some laws also use the word financial lease. For example, insolvency bankruptcy code uses the word finance. It says financial debt includes a financial lease, and it does not define what's a financial lease. Rightly speaking, it says a financial lease is one which is as per definitions given in applicable accounting standards. Similarly, the Surfacy Act also tries to capture words like financial lease, hire purchase, conditional sale. These are not defined in statutes. The definition is left to the accounting standard. So accounting standard therefore become the fountainhead of the distinction between financial and operating leases. And let's understand the key indicia, the key indicators of a financial lease. So first, try understanding that the basic meaning of a financial lease. What we have over here, I've got 5 indicative tests here. These are indicators. That's not the meaning of financial lease. These are indicia, indicators. The meaning is a lease under which risks and rewards of ownership of the asset are transferred to the lessee. So basically, we're saying if the substance of the lease is transfer of ownership related risk to lessee, lessee becomes a virtual owner. In a loan transaction, the lessee is the owner of the asset. Lessee acquires the asset with borrowed money. If in a lease transaction, the lessee is likewise acquiring the asset with external funding, then the nature of the transaction, the lease nature, becomes merely a facade. I'll repeat the last few minutes to say that the basic meaning of a financial lease is substance over form. That would mean, in substance, this transaction, which has the look of a lease transaction, has the substance of a financing transaction. Looks like a lease, but intrinsically it is a financing transaction. That would mean if you were to unravel the substance, look beneath the outer appearance of the transaction, it has the same feature as that in any financial transaction. So from point of view of risk and rewards, from point of view of substance, the transaction is closer to a financial transaction rather than a lease transaction. That's what we will call a subjective test. Obvious enough, because no one substance of something is not revealing on the surface. Substance is always hidden, which is why we say the substance is different from the form. If the form and substance was the same, then there would be no reason for us to doubt the character of the transaction. If we call it a lease transaction, we'll probably say it's a lease. What is called a lease should be lease. What is called a lease may actually be a financial transaction would happen only when the look and the intrinsic content of the transaction are different. So the question would be, how do we understand the substance? We do understand that we need to go by substance rather than the form, but how do we know the substance? How do we decide what is the substance of the transaction? For the purpose of determination of substance, there are some tests. Now these are what you call illustrative tests, and they are not, neither are the decisive nor are they exclusive tests. Therefore, these tests are commonly used, but if otherwise, other than because of these 5 tests, if it's otherwise visible that the substance of the transaction is that of financial transaction, we would still regard it as a financial lease. So the most important feature, the most important indicator of the lease being financial lease is the first one. I'll read them first and then say why is the first one most important. Number one, the full payout test. Full payout test meaning full, and last episode also we discussed what's full payout test, meaning if the lease fully pays out the principal of the through the lease rentals, through the guaranteed residual value, the lessor is able to recover the whole or almost the whole of his principal. That is, it's a full payout, is recovering the full investment by way of guaranteed lease rentals. Then the lease should be a financial transaction. Like in case of a loan transaction, the lender recovers the whole of his principal by way of loan repayments, loan EMIs. Similarly, the rentals are similar to EMIs. If they're recovering the whole of the investment of the lessor, the lease ought to be a financial transaction. That's the so-called full pay. I'll come back and explain that in a bit, because that's the most crucial test. So I'll need to dwell further to explain each of the terms used there. The next is transfer of title. The lease automatically transfers title at the end of the lease tenure. That is, once the lease rentals are paid, title gets automatically transferred. The lessee becomes the owner of the asset. That's also a financial lease. Recollect from the discussion in the first episode, we said this is what is called a conditional sale. Conditional conditional sale meaning what? Subject to condition of payments being made, there'll be a transfer of ownership. The sale will happen conditional upon payments being made. So, from accounting standards viewpoint, even a conditional sale amounts to a financial lease because accounting standards are dwelling upon substance and not the legal form. So, a so-called hire purchase, which is the next item, bargain purchase option. The lease provides a bargain purchase option. Once again, if you recollect from episode 1, we said a hire purchase is one which transfers ownership at a price of rupee 1. So that's a bargain purchase option. So a lease which has a bargain purchase option, a lease which automatically transfer title, which are respectively called hire purchase or conditional sale from legal perspective, are also treated as financial lease from accounting standards viewpoint. The next test is lease term. Tenure of the lease is more than 75% of the estimated economic life. Economic life of the asset. Quite often people may mistake economic life with useful life. Economic life meaning the life of the asset to work as such. Useful life is different. Useful life is the usability of the asset by me. For example, if I have a policy that I will not use laptops beyond 3 years or beyond 4 years, for me the useful life of a laptop is 4 years. But a laptop functions a laptop for good 20 years. In that case, economic life of the laptop is not 4 years, it's 20 years. Economic life is the ability of the asset to serve the purpose for which the asset is designed. For example, a car works like a car for 15 years. The car's economic life is 15 years, though I may not be using cars beyond 5 years, in which case useful life for me is 5 years. Here we are talking about 75% of the estimated economic life. Usually speaking, this test is rarely used in practice because economic life of most assets can be much longer than useful lives, and therefore the lease tenure being longer than three-fourths of the economic life is rarely seen. Therefore, this test is mostly not relevant in practice. Last test, the equipment is specialized. Specialized meaning so specialized that outside of this specific use, the equipment is placed with a particular lessee. Outside of the lessee, the equipment will hardly have any value. That would mean the equipment has to be used by the specific lessee only. It cannot be used outside the particular lessee. That would mean there is no intent of taking the equipment back because it cannot be used by anyone else. It's so configured, it's so tailored or so designed that it can be used only by a specific lessee. That also indicates that the intent is that the asset would remain permanently with the particular lessee. Hence, the lease becomes a financial lease. So, I said most important test in real practice, if the lease has a bargain purchase option, very clearly it's a financial lease. If the lease transfers title, it's very clearly a financial lease. If the lease is a full payout transaction, meaning the structure of lease rentals is such that over the lease tenure, the non-cancelable lease tenure, the lease rentals pay bulk of the lessor's investment. I use the word bulk, and here in the slide you find me mentioning 90%. This 90% is the expression we bring it in practice. The standards would actually say substantially the whole. Standards don't define a numerical percentage. Standards say recover the whole or substantially the whole of the lessor's investment in the asset. It uses word like substantially the whole. But in practice, we say if the lease payments, if the lease rentals, unconditional lease rentals are recovering 90% or more of the investment in the asset, then the lease should be a financial. I'll repeat the test once again, it's most important, and then I'll say it reciprocally as well. So if the lease rentals are recovering 90% or more of the lessor's investment in the asset, the lease ought to be a financial lease. Because in that case, since rentals are fetching 90% or more of the lessor's investment, that would mean what? The lessor's risk in the asset is how much? If the lease rentals are fetching 90% or more, that would mean the lessor's risk in the asset is 10% or less than 10%. And therefore, with less than 10% stake or less than 10% risk in the residual value, the lessor does not have a significant enough or material enough risk for the lease to qualify as an operating lease. To therefore put it reciprocally, in order for a lease to be regarded as an operating lease. Important point, therefore, I would reiterate that in order for a lease to qualify as an operating lease, the lessor's risk in the asset value in present value terms should at least be more than 10%. Higher it is, the better. It should be more than 10 because 90% or more of the investment being recovered by way of lease rentals would mean the lease is a financial lease. I've used some terms here, minimum lease payments. These are to be discussed when we discuss accounting standards specifically. So now that we understand the meaning of financial lease meaning what? I'm recovering the whole of the investment in the asset by way of lease rentals. Operating lease is one where the exposure of the lessor in residual value in present value terms is more than 10%. So we understand what's a financial lease, we understand what's an operating lease, we understand what is hire purchase, and we anyway understand what's a loan transaction. Therefore, it's time for us to quickly wrap up our understanding of each of these four optional, forms of contract, understand the overall difference between these four, which will then assist us to go back and discuss the various, the various intricacies of these four products from different perspectives. So I'm stating this very important distinction. Therefore, these two slides say a lot, and I'm stating it quickly. We intend to elaborate them further as we go into further discussions later with later episodes. Legally speaking, that is legal nature, by way of legal nature, financial lease, operating lease, or hire purchase. It's legal nature of the contract. Legally, who is owning the asset? The lessor is owning the asset. Therefore, ownership of the asset stays with the financial in a financial lease as well. The ownership of the asset remains with the lessor in operating lease as well. The ownership of the asset remains with the financier in case of hire purchase too, because hire purchase also gives an option to buy only at the end of the term. Until then, I am the owner. Therefore, ownership is retained by the lessor in each of case number 1, case number 2, and case number 4. Option number 1, 2, and 4, ownership stays with the financier. It's in case of a loan transaction that the ownership is with the borrower from the very beginning. And therefore, the legal nature of the contract, in case of a financial lease, renting of an asset. In case of an operating lease, it's also renting of an asset. In case of hire purchase, renting of the asset, but with an option to buy. Option to buy may be there in financial lease or operating lease as well. Question is, what sort of an option? Remember from episode 1, we said option to buy such which is bargain purchase option. Option at a price where it's almost certain that the option will be exercised, right? So therefore, the nature of the income, legal nature of the income, in case of financial lease, we are earning a rental. Legally, we are earning a rental. In operating lease also, we are earning a rental. In hire purchase, we are earning a hire charge or call it rental. In case of a loan, we are recovering interest and principal. Residual value, in case of financial lease, if you're taking a guarantee from the lessee, that would mean the lease is a financial lease. In case of operating lease, we don't expect the residual value to be guaranteed by lessee because the lessor does take his own risk on residual value. Question of any RV risk in case of loan does not arise. In case of hire purchase, I had mentioned earlier in episode 1, it's traditionally been 1 rupee. That is, the option to buy is given at 1 rupee value. Now, very important to understand the accounting distinction. Accounting distinction depends on what accounting standards are we following. Now, as it appears, as it now transpires, accounting standards for lease transactions have undergone a significant change. They were there earlier. The accounting standards were different. From 2019, the accounting standards are different. World over, there is a change. I wouldn't say world over the change because a very significant part of the world, which is the USA, has still not adopted the international accounting. So accounting standards on lease transactions are different depending on which standard are you following. If you're following IFRS or Ind AS, accounting standard is different. If you're not following Ind AS, accounting standard is different. If you're a US entity, the accounting standard is still different. So accounting standards on leases are different in different countries. Let me just try quickly, therefore, stating that this will be discussed at length when we discuss accounting for lease transactions later. First, let's talk about the accounting in the books of the lessor, the financial. In case of a financial lease, is the asset characterized as asset of the lessor? Remember, we said the asset is owned by the lessor. From legal perspective, the asset is owned by the lessor. But from books of accounts point of view, we do not show the asset as asset of the lessor. The asset is not shown as the asset of the lessor. Rather, the lessor simply shows the receivables from the lease as a current asset. Current meaning it's like a receivable. Current versus non-current depends on the tenure, but the asset is treated as a receivable by the lessor, not as a fixed asset. In an operating lease, however, the asset is treated as a fixed asset. So very important distinction. Financial lease, it's only a receivable that comes on the books of the lessor. Operating lease, the asset itself, the asset given on lease is accounted for as the asset of the lessor. In the case of a loan, well, the question of accounting for the asset does not arise because the lessor is simply given a loan. In case of hire purchase as well, traditionally hire purchase has always been taken as asset owned by the hirer, by the user, not by the financier. Therefore, the asset is not put on the books of the financier. The asset is put on the books of the borrower. So that's a very important distinction. Accounting. So we are deviating from legal ownership there. Legally, the asset is owned by the lessor in case of financial lease. Legally, the asset is owned by the financier in case of hire purchase as well. But both in case of financial lease and hire purchase, the asset is not treated as an asset in the books of the lessor. Rather, the lessor only shows the receivables from the lease as his asset. Because the asset is not capitalized by the lessor, the question of therefore depreciating the asset does not arise. The depreciation is concomitant with capitalization. If the asset is capitalized, the asset is depreciated. Since the asset is not even capitalized by the lessor in both financial lease and hire purchase, the question of depreciating the asset does not arise in either of these two cases. In case of an operating lease, however, since the asset is capitalized by the lessor, the asset is also depreciated by the lessor. Therefore, once again, very important, in case of an operating lease, from accounting perspective, the asset is capitalized by the lessor as also depreciated by the lessor. This is a very important point because later as we discuss accounting standards, we will understand that the depreciation policy in case of leased assets is such which causes a very significant impact on the P&L of the lessor in case of operating leases. Now let's look at the books of the lessee. In the books of the lessee, now depends on whether the lease is a which accounting standard is the lessor following. If the lessee, which accounting standard the lessee is following. If the lessee is following IFRS 16 or Ind AS 116, IFRS 16 is a global equivalent. Ind AS 116 is the Indian accounting standard. I did mention that US has not adopted IFRS 16. US goes by standard called ASC 842, which is similar to the Ind AS 17 as it used to be. Therefore, US is still aligned with the old accounting standards and not the new. But I don't think we need to discuss US accounting standards at length here, but we'll be making a passing reference to the US standards as well. So in the books of the lessee, if the lease happens to be financial lease, well, it's capitalized on the books of the lessee. If the lease happens to be operating lease, in that case as well, if the lease happens to be an operating lease as well, in that case too, if the lessee is adopting Ind AS 116, the lessee will be recording what is called right of use and obligation to pay liability, ROU asset. By the way, in case of financial lease or operating lease, the distinction between financial lease or operating lease is not relevant. Important point, therefore, I reiterate that the distinction between financial lease and operating lease is not relevant from point of view of lessee accounting. It's relevant from point of view of lessor accounting. Distinction between financial lease and operating lease is not relevant from point of view of lessee accounting under Ind AS 116 or IFRS 16. That would mean for every lease, what we will capture in the books of the lessee is an asset called ROU, right of use asset. Correspondingly, we'll have a liability called OTP, obligation to pay liability. As to how is ROU asset captured, OTP liability captured, that would form part of our discussion nature. But as of now, very quickly stating that IFRS 16 or Ind AS 116 has eliminated distinction between financial lease and operating leases from viewpoint of lessee accounting, retaining the distinction from viewpoint of lessor accounting, but from lessee accounting point of view, the distinction has been eliminated, and therefore consistently, that is between both, in case of either transaction, what is accounted for on books of lessee is ROU asset versus OTP liability. In case of a loan, well, the accounting is quite simple. The asset is capitalized and the borrower records a liability to make a payment to the lender. Same goes in case of hire purchase too. By the way, if the transfer of title is very clear, like it's a conditional sale kind of a transaction, then under IFRS 16 also the asset may be capitalized by the lessee directly without bringing on books something called ROU asset. Now, if there is an ROU asset, that would, as per Ind AS 116 or IFRS 16, the ROU asset will also be depreciated. In case of a loan, the question of depreciating does not arise. In case of hire purchase, depreciation, of course, is provided by the borrower or the hirer. Now, another very important point, and this is very specific to motor vehicles. In case of motor vehicles have a certain document called registration certificate. A lot of people tend to think the registration certificate is a document of title, but actually it's not. Motor vehicles registration certificate is still a document of registration, registered owner of the motor. It's not legal owner of the motor vehicle. It talks about registered owner. So for motor vehicles purposes, if the asset is given on a lease transaction or hypothecation transaction or hire purchase transaction, it's possible to have an RC, registration certificate, in the name of the actual user. I'm sure you understand that a motor vehicle law or the operation of a motor vehicle brings in a whole lot of operational issues. For example, crossing a traffic signal, I mean, overspeeding of the vehicle, hitting someone, doing an accident. All of these are offenses under motor vehicles. And who gets the red slip or the notice if you cross the traffic signal or you overspeed the vehicle? Who gets a notice? The scanner on the road will take your the RC will take your number plate and look at the owner of the vehicle as per registration certificate. Will shoot the notice will automatically come in your on your registered mobile number. So that's coming on the registered mobile number of the person in whose name the registration certificate vests. Assuming the lessor would have the RC in his name, he'd probably be getting 10 such notices a day, because out of 1,000 vehicles given on lease, probably 10 might be doing something or the other every time. So it would, in order to make life easier for lessors, this was a specific enabling provision added in the Motor Vehicles Act 1988 to say that in case of vehicles given on lease, it's possible for you to have the RC in the name of the actual user, which means the borrower, and merely have an endorsement in the name of the lessor. So this is the endorsement is there in case of lease, financial or operating doesn't make a difference. In case of a lease transaction, in case of a hire purchase transaction, or in case of a hypothecation transaction. That would mean in either case, either of these four cases, you can and you should have the RC in the name of the actual, I mean, user of the vehicle, rather than have the RC in the name of the legal owner, because that would make life miserable for the financial. That's a very specific exception in case of motor vehicles. Now, income tax is largely a country-specific issue, and therefore, law on this depends on which country you're talking about. Generally speaking, if it's a financial lease, transaction, well, depends on whether the lease is financial lease or operating lease. Mostly does not matter. What matters is the lease true lease? Now, this once again a nuance, and therefore we need to distinguish and develop this further. If the lease is truly a lease, financial leases mostly will not be meeting the test of a true lease. Financial lease, because the overarching characteristic of the lease is that of a financial transaction. A financial lease mostly will fail the test of a true lease because the lessor is not a true owner. Lessor is legal owner but not truly the owner of the asset. Therefore, the lease would mostly not qualify to be a true lease. However, assuming that the lease is a true lease, even though it's a financial lease, but it's a true lease, well, then the rentals are taxable and depreciation claimable by the lessor in case of financial leases too. This has been the ruling of the Supreme Court in a case called ICDS. ICDS is the name of the company. Supreme Court ruling. It's talking more from point of view of deductibility of rentals, but correspondingly, the taxability of the rentals and deductibility of depreciation also becomes evident from that. However, I would say, however, if the lessor was interested to claim depreciation on the lease, and I did mention that a financial lease mostly will not meet the test of being a true lease. Therefore, the more preferred option for the lessor wanting to claim depreciation will be to go for operating lease. Because the distinction between true or not true is still subjective distinction. It would therefore be preferable to structure the lease as an operating lease if the lessor intends to claim depreciation on the asset. On the contrary, if the lessee wants rentals to be deductible, the lessee would rather go for an operating lease because that's where rentals are tax deductible. The question of claiming depreciation by the lessee does not arise. So in tax laws as such don't distinguish between financial versus operating leases. Tax laws distinguish between what is truly a lease versus a disguised financial transaction. And mostly a financial lease will find it very difficult to qualify as a true lease, particularly because the financial lease is not shown as the asset of the lessor. So to go to a tax officer and say that there are assets on my balance sheet which are not showing and I will still claim depreciation on those assets would be quite a tough call. Now, from point of view of financial regulations, very quickly talking about number one, the RBI regulations, because RBI is concerned with financial transactions. Therefore, RBI's regulations are mostly applicable to financial leases only. RBI has not specifically made the distinction, but it's evident that if the operating lease is not a financial transaction, an entity which is engaging principally in operating lease business is therefore not a financial entity because operating lease is not a financial transaction. Operating lease is not financial business. An asset given on operating lease is not a financial asset. Income out of operating lease is not a financial income. Therefore, an entity focusing principally on operating leases would not be a financial entity. Will not be meeting the so-called principality test for financial entities. And likewise, even if assuming the entity is a financial entity, it does operating leases as a non-principal activity, the income out of operating leases will not be subjected to the typical RBI norms of concentration, provisioning, or income recognition. I'm not saying there are no norms at all. I'm not saying that you are free from provisioning or income recognition completely, but the typical norms of reversing the income, making a provision for non-performing assets, etc., that's not applicable to operating lease because it's more like an asset-based transaction rather than a financial transaction. GST, by the way, does not make a distinction between financial leases and operating leases. GST does not make a distinction. GST is therefore applicable on the lease rentals in case of financial leases. It's applicable on the lease rentals in case of operating leases. It's applicable on the value of goods in case of hire purchase too. Hire purchase is taken more like supply of goods. Leases are taken more like supply of services. This was a quick overview of distinction between financial leases, operating leases, hire purchase, and loans. And like I mentioned, we intend to get into nuances of each of these. So at this juncture, I would park the discussion here and see if any of you have any questions thus far before we move to the next episode. Next episode, we will be discussing more on the accounting standards first. I don't think I'll probably have to phase it out. Probably we'll discuss legal aspects of leasing first and then move to accounting standards. So maybe episode 3 might be on legal aspects of leasing. But at this juncture, does anyone have any question? If not, then we might. Any question?
Sir, I have one question. Sir, you told that in case of financial aid, GST is applicable, while in loan, the GST is not applicable. So is this not a
Interest on
discouraging?
interest on loan, there's no question of a GST. GST is applicable on charges other than interest. For example, service charges, processing fees, prepayment charges. GST may be applicable on items other than interest. For interest on loan, there is no GST at all. Whereas in case of financial leases, even though we understand the rentals comprise of interest as well, but there's no distinction between interest and principal when it comes to GST. The entire rental, therefore, is chargeable to GST.
So is this, sir, not a discouraging factor
It is
for
discouraging.
someone?
It is Yes, it is discouraging. I mean, there is no level playing field between lending and leasing when it comes to GST.
Sir, I have a question. So,
Mhm.
on the tax perspective, we said that if it's a true lease, the lessor can claim depreciation. So if it's not a true lease, can the lessee claim depreciation on the assets?
If it's financial lease, I mean, the asset is kept. Okay, by the way, if the lessee is adopted India's 116 on his books anyway, the asset that would be coming would be ROU asset. So if the lease is a straightforward financial lease, the possibility of the lessee claiming, the lessee capitalizing and claiming the asset for tax purposes is depreciation, the possibility is quite strong. However, I would say in practice, a lessee would prefer to claim the rental as an expense rather than claim the depreciation. I did mention that Supreme Court ruling in the case of ICDS dealt with a financial lease, and the ruling permitted the lessee to claim rental as a tax reduction. So a lessee would prefer, I mean, between claiming depreciation versus claiming depreciation plus interest in that depreciation plus interest versus claiming rental as an expense, I would say mostly the lessee would find it better to claim rental as an expense. But if the lessee so chooses, while we are going to discuss the taxation aspects at length later, if the lessee so chooses, he may claim depreciation plus interest.
Okay, sir.
One question: if the um, if the residual value risk is hedged by the lessor, then will that lead to the arrangement being a financial lease for the lessor, while at the same time being operating lease for the lease for the lessee?
Yes, sort of. Yes, it may result into a situation where the same lease is a financial lease for the lessor, whereas it's operating lease for the lessee. I would also caution you that if the lessee is adopted India's 116, whether the lease is a financial lease or operating lease may not matter, because in any case the accounting would be based on ROU asset, not financial versus operating lease distinction. However, the lessee is adopted not India's 116 or IFRS 16, the lessee is adopted IS 17 or IGAP for that matter, or the lessee happens to be a US entity, then it may be still possible that same lease transaction qualifies as financial lease for the lessor and does not qualify as financial lease for the lessee.
There's just one clarification needed. In residual value, you said client guaranteed. So if you can just
Lessee
clarify,
guaranteed. Lessee guaranteed.
what does
I mean,
that mean? Huh.
I mean, for instance, if the lessor is placed, let's say 10% value, which means the lessor is recovering 90% of the asset cost by way of lease rentals, he is leaving 10% risk to be recovered by way of residual value. Now, he doesn't want to take that risk also. He probably say, well, I don't want that 10% risk also. Therefore, I would want the lessee to assure a residual value of 10%. Meaning what? That should the value of the asset fall below 10%, then I would recover the deficit from the lessee. So I have the right to recover any deficit over the assured or pre-agreed residual value from the lessee. On what basis? Lessee was the one exclusively using the asset. He might have used the asset, he might have abused the asset, he may not have maintained the asset, he might have overused the asset, and therefore if he is responsible for bringing down the value of the asset to less than 10%, he should pay the difference. That would mean I am assured of a 10% value from the less. Anything less than 10, I have a right to recover the difference. If the asset fetches more than 10, well, it's my gain.
Understood.
Okay. Any other question at all?
Just one last point. Yesterday, in the first episode, you mentioned that for the lessee, one of the benefits were that it is an asset-light model. Leasing as an option is asset-light. Under Ind AS, if the lessee is falling under Ind AS, this particular
Does not apply.
benefit will not.
Does not apply.
Yeah.
If the lessee falls under Ind AS 116, then only if the lease transaction is completely outside Ind AS 1 month. For example, it's less than 12-month lease transaction. Only in that case, it would be completely off the balance sheet. Otherwise, off balance sheet, I mean, one of the very purposes, one of the very important guiding principles of Ind AS 116 was to kill off balance sheet accounting. I mean, Ind AS 116 was designed to eliminate off balance sheet accounting. Therefore, the idea of Ind AS 116 is that no lease is actually off the balance sheet. Every lease will result into at least some component of what is ROU asset. By the way, if the lease is, let's say, an operating lease with a significant retention of residual value risk by the lessor, ROU asset will come on the books of lessee, but ROU asset will come to a lesser extent. And there would still be a significant, what you call, off balance sheet component. Entire asset would not be off the balance sheet. Neither would the entire asset be on the balance sheet. ROU asset, therefore, would still be significantly lesser than the complete value of the asset. That's something that we intend to get into more discussion as we go into accounting aspects later. So I would assume in episode 3, we talk about legal aspects of leasing. Episode 4, we can talk about accounting aspects where we take the financial lease versus operating lease distinction, and then we talk about ROU versus OTP liability, and then we take income tax, GST, and thereafter. So that's the plan. Thanks very much for joining today, and look forward to seeing you all in the 3rd episode. Bye-bye.